Good evening, everyone. I thought this was a really interesting way to sort of start this evening, to kind of step back and give us a little bit of perspective. I mean, even though this chart actually ends in 2018, so it's not quite up to date, but I like the fact that it ends on a downturn to really make the point, which is not only that a dollar invested in the S&P 500 in 1927 would be worth about $5,900 at the end of 2018, or $1,000 invested in the S&P 500 would be worth $6 million today. But this is a great time to sort of step back and get that perspective to see over that period of time all the crazy things that happen in this world, the crazy times we went through. I think this is a time where we all kind of really relate with crazy times and really see that despite all of that, as Warren Buffett says here, we have always inevitably been able to release that potential with, as he says, interruptions here and some volatility. But over time, we've always been able to release that potential, expand our lifestyles, extend our lifestyles for us and for future generations, even though I think we can all be, I'm sometimes a little bit worried about the future generation for my three children, but it's always worked out in the long run. So I think we can. Oops, sorry about that. So I think we can all feel confident that I'll continue to do so. Now I should introduce myself. My name is Sean Crockett. I'm one of the partners here at Endurance Wealth Partners. Endurance Wealth Partners is really this bringing together of a bunch of financial advisors, financial professionals with different areas of expertise, different areas of specialties. So whether that be accountants, lawyers, financial planners, elder care planning specialists, estate planning specialists, philanthropy planning specialists, and all sorts of different areas I could go on, bringing them together to bring all of those to your disposal. And then by design, making sure that we have those professionals in every generation from their 20s, 30s, 40s, 50s, and 60s, so that we have the endurance to work with you to help guide you to be the best stewards of your wealth over time. And to make sure that we have the resilience, because that's what we really need, not only to guide you as the stewards of your wealth, but to guide the future stewards of your wealth over generations. Now, to be resilient, we're going to have to adapt to a constantly changing world because, in my 52 years on this planet and for the centuries of history that I've studied, the one constant, other than taxes, has been change. There is always change, and sometimes change is more rapid through some periods, and we are in one of those times. We're certainly at a time where, new politics with our largest neighbor and trading partner to the south, a little bit more nationalist, protectionist, which is leading more to restrictive trade policy and tariffs, as we've all heard about and experienced. And this is part of a bigger populist movement that we've seen globally. We've seen this in many different countries, and this and some other things are creating some geopolitical tensions. And I always like to say, there's 5 people in my house here. And through our lives, we can't go through that without some tensions. We got 8 billion people on this planet. We're not going to get through that without some geopolitical tensions. Geopolitical tensions have always existed. But of course, more recently, that has ignited into some armed conflict, which is obviously not something that any of us like to see either. But underneath all of that, there have been a lot of results of pro-growth policies, of a very accommodative growth environment, and some innovations that have really been fueling a strong economic engine, especially with our largest trading partner to the south. So while there's some challenges there, there is also a lot of opportunities there at the same time. And one of the most pro-growth factors, and one of the factors that if you want to think about the long-term picture of your wealth and your investments, one of the greatest things to pay attention to is productivity, which is really sort of a great gauge of that sort of innovation and ingenuity that I was talking about earlier. And if you look at productivity now, it's rapidly and immediately being enhanced by technology and artificial intelligence in particular. So, from an investment perspective, with all of these sort of cross currents, how do we navigate all of those for you, especially when they're happening so quickly? We do that by rapidly processing and analyzing information that goes beyond the headlines and deeper than the headlines. And we do that with expertise, with experience, with skill, and with knowledge. And in order to do that for you, what we do at Endurance Wealth Partner is we partner with professionals that have that deep experience, have that education, have those boots on the ground that are actually talking to the central bankers and talking to the government officials, and most importantly, talking to the CEOs and CFOs of the companies that are driving a lot of that change, which is very consistent with our values, that we are stronger together. If we can bring together hardworking, knowledgeable, skilled, and experienced professionals, the more of those we can bring together, it just means that we are all stronger and that your wealth is stronger. And so today, that's exactly what we've done. We've brought two of those individuals who represent partners that we deal with. The first, Lauren Gavsey, who's the Senior Vice President and Head of Macroeconomic and Foreign Exchange Strategy at CI Global Asset Management. Lauren has 25 years of experience in the industry, so he's seen a lot of things in his time, and probably has a lot to relate to the current situation. Before joining CI GAM 10 years ago, he had similar roles at major Canadian banks in London, in the UK, and Toronto. So, a worldly gentleman as well, and is currently a member of the Bank of Canada's Canadian Foreign Exchange Committee. So, obviously, in the middle of a lot of what's going on now. Now, CI GAM runs over $420 billion for Canadian and US retail. So individuals like you and institutional large pension plans and such investors, and is one of the large investment firms in Canada. And Lauren, I'll congratulate you. It seems that you recently won 19 Lipper Awards. So that also goes to show sort of the product of a lot of what you've been doing and what CI GAM has been doing. Now, we're also very, very fortunate here to have David Tulk with us as well. David also has over 20 years experience as both an economist and an investor, starting his career and spending many years of his career at the Bank of Canada. So he's knows how these conversations go, and so can shed a lot of light on it for us. He then held some positions with the Ontario Teachers Pension Plan and global macro strategy for a major Canadian bank. He joined the Fidelity Global Asset Allocation Group 9 years ago. The Fidelity GAA team, as we like to call them, they run over $2 trillion worldwide for individual investors and institutions. And they're made up of over 100 asset allocators and macro specialists. And that's really what the sort of message that David's going to bring us today from that large group around the world. And they actually gather from the over 1,000 investment professionals around the world at Fidelity. So a lot of perspective here, and really two individuals who represent two of the institutional partners we work with to make disciplined day-to-day decisions on your portfolio. So with all the rapid change going on, we thought it was a good time to hear directly from them. So we're going to spend the next 35, 40 minutes just having a conversation about what's going on out there. We want you to join the conversation. So at the bottom of your screen, or maybe if you move your mouse around a little bit, you'll see come up, there should be a little box there that says Q&A with a little bubble, or chat. Either of those. I'm going to try and monitor those throughout the course of our call today. We'll try and get your questions answered. There's over 100 people on the call, so we may not get to everyone's questions this evening, but please do ask them, because anything we don't get to this evening, we'll get the answers from our partners, and we'll make sure that your dedicated financial advisor gets those out to you. So, Lauren, let's start with you. Let's get the conversation going. So we've got this new government in the White House that the one thing I can say for sure, they certainly like to make headlines. So So how do you and the experts at CI GAM sort of sift through this daily news flow? And most importantly, what do you think it means for Canadian investors and for the people on the call today?
Yeah, well, firstly, thank you very much for having me. I appreciate the opportunity and to join David on this call and have an interesting discussion on some interesting topics right now. So to get right to the point, I mean, first of all, it's been a roller coaster. And for investors, and I think for Canadians in particular, it's been an emotional roller coaster, and we can't ignore the fact that this has been, it's what something we call in the business tape bombs. It's just recurring headlines, nonstop, and it's coming from all angles when you think about access to media and access to information nowadays. So that's a challenge. It's something that we have to recognize. Our clients are faced with it, and we as investors are certainly not immune to it either. So the first step is recognizing it's an emotional trigger, but it's not necessarily something that you need to react to or immediately jump to a conclusion on. So we're quite cautious, and we do certainly, the discussions are ongoing. You can't ignore these things, but we try to take a bit more of a pragmatic approach to things. So firstly, I have to tell everyone, because my colleagues have been laughing at me and giving me a hard time for the past day, I finally caved yesterday and downloaded Truth Social. I thought, you know what, if I'm going to want to see news from the source, I've got to go to where he puts that information first. So mea culpa, I finally bit the bullet. I am a Truth Social member, I guess.
You're a step ahead of me, Gordon. You're a step ahead of me.
Exactly. So I just want to give you guys, share kind of an approach that we've taken as far as how to think about the various different types of policies that Trump and his administration tend to speak out on, but really it draws from a meeting I had. I had an opportunity to sit down with a gentleman named Chris Liddell, who was the deputy chief of staff under Trump 1.0. He's actually the former CFO of Microsoft. And he shared a little bit of insight as to how to think about all of this noise. He said, listen, Donald Trump can get caught up and go off on tangents right, left, and center. But at the end of the day, there tends to be a small handful of really clear policies that are important to him. Those are the key objectives. And they won't come as a surprise, but I'll just list them out to you. It's 5 with maybe a 6th tagged on. Tariffs, high on that list. Immigration, government efficiency, or DOGE as they've called it, deregulation, lower taxes. Those are the 5 key policy frameworks that just about every decision he's making is targeted or focused on improving or making changes to those areas. The 6th that I would add at this point, it wasn't part of my initial or original framework, would be global security, and certainly questions around NATO participation. And we're seeing things like what Germany is just about to pass or hoping to pass, which is a huge increase in spending on military spending. We're seeing a bit of a realignment going on, but again, I don't want to jump to conclusions. This is a lot of chatter, a lot of risk, potential risk. So we're aware of it, we're on top of it. And then the second thing we want to think about is, what are the economic implications from all of these different categories? So what are the economic ramifications from tariffs or from a reduction in government spending? And how soon will they impact the economy? And therefore, how soon will they actually be material for the market and for different sectors? So we're trying to think about it in a very organized way to help us arrive at, do we need to adjust any of our allocations? Do we need to become more defensive in our positioning in our portfolios? Do we need to think about repositioning from a currency standpoint, from a bond standpoint? What do we think about credit and so on? So we're quite methodical in how we approach it and focusing on those key objectives, policy objectives. And we also think about it from a, what does it mean for Canada perspective? And obviously these tariffs could be quite material. And the big question is, how long will they last? So we call that duration. And what will be the breadth? So does it continue to be this kind of wide stroke paintbrush, 25% on everything? Or what we've actually seen today is a little bit of a pullback on that. And they're saying, well, we're going to actually excuse tariffs on the auto sector for another 30 days. Does it become a bit more targeted? And as it becomes more targeted, it becomes a little less impactful on the Canadian economy. Now that's a big question mark. He could quickly revert to these higher tariffs. So the outlook for the Canadian economy, what does it mean? Those are important questions. I suspect we'll get into them a little bit later, but the point is there's still decent opportunity in Canada. Even if some of those tariffs are imposed, there's areas of opportunity from an investment standpoint. It's not all bad. We're undergoing a number of changes within our country at the government level, federal government level as well. Those will be important and key drivers, both from a negotiation standpoint, but as well from an economic driver standpoint. I think maybe just the last comment I would make to the question of how do you manage through these headlines as an investor? We're not looking to react to every single headline. We are looking to invest from a medium to long term. We want to be quite thoughtful and we're not simply going to all of a sudden reallocate or adjust our weights by significant amounts in response to what we believe is at this stage speculation or an abundance of information with a lack of fact or follow through until it becomes a bit more firm and official and investable. We do our best not to overreact to it.
So David, maybe I'll sort of take the same question over to you and sort of, how is Fidelity and the global asset allocation team shifting through this information, and what do we think is, what does it all mean for a Canadian investor?
Yeah, no, absolutely. I think I would echo a lot of what Lauren said in terms of really the most important thing in terms of investing and with all of this volatility and uncertainty is just to try to take the emotion out of it. These are very emotionally fraught times. I think we all feel that. But when it comes to making investment decisions, trying to be as unemotional as possible is really the right approach to take. And then beyond that, I think it's also incumbent on people to become diversified. So given the uncertainty, given the wide range of outcomes, if you have diversified allocations to different asset classes, different geographies, different styles of investing, I think that's a really important way to at least allow for a greater probability of success, just given that, to be perfectly honest, nobody really knows exactly what tomorrow is going to bring. And if you can just watch how markets have responded to the litany of tariff headlines in the last week or so, that demonstrates that point fairly clearly. So that's sort of the advice that I would have in this type of environment, is to also really, look through the daily volatility. I know it's hard, but do your best to try to do that and really focus on your medium-term plan. So everybody has their investment objectives. We've seen, Sean, as you mentioned off the top, lots of periods of history where there's volatility and uncertainty, but maintaining a focus on that medium-term plan, I think, is also a way to not make rash decisions, because I think, as we know, it's virtually impossible to try to time the market. So spending time thinking about the longer-term themes, that's really where we're taking our portfolio. So when we think about a lot of the decisions that we're making, we're trying to, again, see through a lot of the noise, try to understand what are some of the motivations of the administration for bringing in tariffs. And I know we'll have a chance to go into this in more detail, but I think part of it is to really, in addition to the list that Lauren provided, is also to just recognize what the U.S. is facing in the next decade or two, which is a lot of competition from China. And what the U.S. is trying to do, I think, is to build what I'm calling a fortress North America. So trying to build as much of an economic powerhouse within the North American context. So that extends all the way down to the Panama and the Panama Canal, trying to at least make sure that that remains a viable U.S. Shipping destination. It extends up to Greenland as conditions in the Arctic maybe change and more shipping lanes become available. Having a definite presence in that part of the world is important. That also extends to Canada and Mexico to a certain extent. So it's an open question as to whether tariffs are the best way to try to motivate these other countries to respond to what you're trying to achieve. But it also reflects, I think, the notion of a deal and the notion of trying to use your advantage to press for the results that you want. And I know we'll have also a chance to get into this, but when we think about the US economy, it's a large economy and it's a generally closed economy, which means it relies less on international trade than many of its trading partners. So there's a natural advantage. So yes, tariffs will certainly hurt the US, but they're going to hurt Canada, they're going to hurt Mexico, they're going to hurt Europe, they're going to hurt China a lot more. And that's the relativism that I think is really underpinning a lot of the actions that the Trump administration is trying to take today.
Yeah, and I have to compliment you both first off the bat because there's two questions that came up in the Q&A, and you kind of answered them. Should we stay diversified and think long term? I think we answered that as well, and that was a very good synopsis of what the end game is for Donald Trump in terms of tariffs, in terms of creating this Fortress America, and I guess using agitation to try and motivate us here in North America to sort of comply with them. And I just ran a poll, so some of you will see I'm throwing up some questions just so we can get all of your views and also so that we can get some thought-provoking questions. And so a little exercise I went through, and I just showed the results to the poll here, was asking a little bit about, in what's happened since Donald Trump was elected. I myself and ChatGPT and Perplexity, it's hard to find the exact number, but between the three of us, we came up with 21 instances where, a comment was made or an announcement was made that was somewhat of a change from what the last comment was. We came up with 21 of them, so most of you were correct. And if I am correct in my calculation, depending on how you calculate it, as of today, somewhere between 5 and 7 tariffs have been kind of introduced, which means that on average, about 1 out of every 3 comments he's made has actually come to fruition, and we don't even know if these are going to stick. So just to kind of echo those comments around, there's a lot of volatility in the current strategy with the White House. It's probably intentional due to negotiation style. And we don't want to kind of react to every headline because it's going to whip you around. And when you get whipped around, that's a good way to lose a whole lot of money. So David, I'm going to start back with you. So it sounds like this is going to be particularly difficult for the Canadian economy. Certainly, our Prime Minister, I believe he's still our Prime Minister, said yesterday that to Canadians that this is going to be tough. We're going to go through some pain. So how does your team from across the world see the investment landscape in Canada? And then maybe if we could extend that to the US, you've sort of led to that a little bit, and then internationally going forward. And then as a result, sort of how are we positioning clients' portfolios as a result?
Sure. No, absolutely. That's a great way to give a flavor of how we are positioning our funds. So I'll start with the Canadian perspective. So one of the consistent positions that we've held in our portfolios is an underweight to Canadian assets. And that was true prior to the emergence of this tariff risk, indeed, prior to the US election. And our concern around Canada is really driven by a number of different factors. So first and foremost, we have, I think, significant challenges facing household balance sheets. So we've seen a very large increase in household debt. We've also seen interest rates move pretty much dramatically higher as well. Some of that has since retrenched, but interest rates are still higher than what we saw in the darker days of the COVID pandemic. So that's still a pretty significant headwind to Canadian balance sheets and the household sector more generally. We also have, again, some stresses, I think, that are lasting in the housing market that we need to be appreciative of. And even more fundamentally, you talked about AI and productivity, but Canada really has had its own productivity challenges that have existed for decades. So when you think of a tailwind to economic growth that comes from improving your economy's productivity, that just hasn't happened in Canada, and we can get into some of the reasons why that's the case. But nevertheless, from our perspective as investors, we see and have seen more opportunity outside of Canada relative to Canadian assets. Now, that's not to say that every Canadian company deserves to be tarred with the same brush. So there are many interesting companies that our building block portfolio managers are bringing into our portfolio. But from where we sit as an asset allocator, where we decide how much we want to put in Canada versus markets around the world, the preference is to be outside of Canada. And when we consider the tariff risk and what this means going forward, that only, I think, underscores the concern that we have facing Canada. So the Bank of Canada has done some simulations on what a tariff shock might mean for the economy. The upshot is that it's not pretty. I think we all recognize that. So it's a permanent hit to Canada's GDP, so the standard of living that Canada will experience. It also implies a weaker Canadian dollar. So that's part of the rebalancing mechanism. So again, from a Canadian investor's perspective, if you're invested outside of Canada and the Canadian dollar is falling, that's providing an additional tailwind into your performance. So the caution that we have on Canada still remains to today. When you think about other markets around the world, so when you are overweight other markets, you have to decide, do you want to be in the United States? Do you want to be in Europe? Do you want to be in emerging markets? And for most of last year, we had a strong preference for the United States. So that was where we determined there was the greatest economic strength. That's where corporate earnings were very robust. It was the US was benefiting from that productivity tailwind tied to AI, so something that Canada has been lacking, but is very much the case, I think, in the United States. The challenge, though, with being in the US is that it was expensive, especially compared to markets around the world like Europe or emerging markets. Now, that degree of being expensive can be sustained for quite some time, unless there's a macro or economic catalyst that can bring prices in line. And I think, and this is very much an ongoing debate that we're having in our team, but we might be at a watershed moment right now, given some of the announcements that we've heard from Germany on defense spending. There's a catalyst, I think, for other countries to recognize that they need to get their own act together and find out a way to grow without relying exclusively on the US to provide a tailwind into their economies. So as we think about that global allocation, we're trying to decide what the right mix is in terms of being in the United States, in terms of being in Europe and the Far East, as well as within emerging markets. So again, in the spirit of diversification, we want to be able to have allocations to each of those regions, but sizing those today, I think, is a work in progress because we need to see how some of these themes evolve over the next number of weeks, months, and quarters.
So some challenges in Canada that go beyond tariffs, I think that you alluded to there for us to think about, but maybe that brings some opportunities in the rest of the world, and certainly the U.S. is doing well. And you touched a little bit on the Canadian dollar, and Lauren, I know you're the foreign exchange expert, so maybe this is just an opportune moment to comment a little bit on Canadian dollar, U.S. dollar, and I mean, I guess the big question do I have is all of this already priced into those currencies?
Sure. So I'm going to unpack it a little bit further and build off of what David mentioned. And I'm going to say there's actually considerable two-way risk with the currency right now. And the reason why I say that is on the side of, yes, we see tariffs implemented, we see a readjustment in the currency, a required readjustment in the currency to offset what is effectively a compression of margins for Canadian exporters. So they're going to see a loss in their net revenue. They're going to have to find that adjustment somewhere else. That tends to come through in the currency. In textbook theory, that's how it works. The country that's actually imposing the tariff will see their currency appreciate. The country that's being imposed upon will see their currency depreciate. So no pushback on that whatsoever, as far as David's suggesting. And by the way, that move could be material. We could be talking about a 5 to 10% type of depreciation in the Canadian dollar. However, on the flip side, I actually see a path, provided that we're able to avoid tariffs from a permanent or call it large tariff percentage perspective, And by the way, if you actually take the 10% adjustment on energy, plus what was announced today, the auto sector is being moved down to a zero tariff effectively, at least for the next 13 days, our calculations suggest that the tariffs are actually somewhere in the neighborhood of about 16%, the net tariff effect on Canadian exports. I found that to be an interesting number. It's nowhere near as severe as the 25 would suggest. That said, if we can get past tariffs, I actually will push back and take the other side from David, and I actually see some upside to the Canadian economy. I totally agree that the Canadian productivity levels have been suppressed to terrible levels. We have not kept pace with the US whatsoever, really over the past 10 years or so. And the opportunity is to see incentive towards business investment, to continue to build on innovation. And it's easy to suggest that Canada does not have innovation. Well, we don't have the AI-driven innovation. There's still an incredible amount of innovation occurring across our country. And then we need population to help drive that opportunity. We need population, we need workers to become more productive in what they're doing. Investment helps that. And the other thing that helps that is a government that's trying to incent business investment, trying to incent innovation. And frankly, it looks like we know we're going to get a change in government. We don't know exactly how aggressive they will be in those policies. It's going to depend whether it's the Liberals, the Conservatives, a minority, a majority. But there is potential to really ratchet things up and kind of accelerate some of the activity that's occurring. And to me, that's a situation where we could see some medium to long-term Canadian dollar appreciation. And at the same time, and I think we'll get into this in a little while, we could start to see the shine come off the US economy to a certain extent. Not suggesting that we're going into a tailspin, but it's been running at an incredibly hot pace. And there's some signs that maybe things are slowing down a little bit, which would take, in theory, US interest rates lower. And as a result, the US dollar lower as well, which gives the Canadian dollar some opportunity to appreciate.
And so it sounds like there's a lot to pay attention to here in terms of how exactly things work themselves out. I mean, we talked about this uncertainty. It really requires at this time, staying on top of how things progress because it could turn things in different directions. And there is a path to potentially a favorable outcome from these negotiations. I mean, we actually do have experience with this government, or at least the current president. He has been president before. And in my last poll question, I asked about the renegotiation of NAFTA. So we have done these negotiations with him before. With NAFTA, he said a lot of scary things, and there was a lot of threats, and a lot of things moved around at that time as well. Eventually, we renegotiated the USMCA. And while the impact of the USMCA, I mean, you can break it down by different pockets of the Canadian economy and different sectors, and they have different impacts. But the consensus, it seems, that I found out there was that when you totaled it all up and averaged it all up, it was moderately positive for the Canadian economy. So, I think the group here got it pretty correct. Little to no impact, or moderately positive. It didn't end up too bad in the end, but there was a lot of volatility along the way, and I think we just need to watch what happens here overall. So there was also a question here, I'll just flip back to it, that relates to what we were just talking about, which is talking about, a strong US consumer, some of the challenges to the Canadian economy. So maybe I'll go back to you, David, and say, is there a potential here that we could be in a situation where the central bank in Canada needs to stimulate the economy, and the US central bank needs to actually sort of put the brakes on the economy from an inflation standpoint? I mean, we're somewhat in that situation now, but maybe you can talk a little bit about, do we think that's likely? Do we think there's a chance of that happening going forward?
Yeah, I think if you take the scenario where tariffs are introduced, and they may not be the full 25%, and there may be carve-outs for some industries, but just accept that there will be tariffs of some form across a wide enough range of goods that trade between the United States and Canada is not as smooth as it was, say, 6 months ago. So if that's your starting point, that type of shock in the context of the US economy, I think is arguably stagflationary, which means it's a combination of higher prices, especially if you get retaliation. So there's an element of an inflationary piece to that, and also some hit on growth as US exporters are hurt by weaker foreign demand through tariffs. So that to me, if you're the US central bank, that's not a great scenario. And it's not a scenario that would immediately demand that you get a lot of rate cuts from the Fed, because you need to keep an eye still on the inflationary impulse in the background. And I can also argue that some of the other policies of the administration can also prove to be inflationary. So if you get more in the way of tax cuts into a US economy that I think is still reasonably healthy, so that's stimulus that arguably the US economy does not need as much as it might if it was in a much more precarious position. But also if you get just the steady drumbeat of deregulation. And that can, again, provide a tailwind into economic growth in the US that could, again, just keep inflation from going back to a level where the Federal Reserve would feel comfortable in potentially cutting further. So I think that lingering risk probably keeps the Federal Reserve on hold. Now, in contrast, if you take that same tariff scenario into Canada, because we're a small open market economy, we will have a much larger impact on economic growth. So exports are about a third of Canadian output, and exports to the United States are about 80% of our total export basket. So that means that, yes, we might see a little bit of inflation in terms of the price of orange juice and things we import from the US, but I think the bigger hit to the economy is through weaker exports. So if you're the Bank of Canada and you need to try to accommodate this shock, the path there is to continue to cut interest rates. And that divergence, I think, between the Federal Reserve staying on hold and the Bank of Canada potentially cutting, I mean, that's an interest rate differential that traditionally does weaken the currency through time. So going back to that same Bank of Canada study that I cited, this was done back in the Trump 1.0 administration, but it made some pretty severe assumptions, certainly about tariffs on a wide range of goods and being in place for a long period of time. But one of the clear sort of mechanisms for the economy to rebalance or to handle the tariff shock was to make Canada cheaper, which in another word is just really to see the currency moving lower. So I think that is a risk. And I take Lauren's point in terms of the US dollar as being potentially under pressure as well. So you might see the Canadian dollar tread water versus the US, but it could depreciate against the euro, the yen, so some of the other basket of global currencies that might see comparatively better performance. And also just make one additional quick point that, there is an opportunity here in Canada that these tariffs are a wake-up call to knock down interprovincial barriers, to try to think about growing more east-west instead of just relying on the north-south relationship that we've had previously. There's also an opportunity to diversify our trade. Again, instead of 80% to the United States, look at other markets around the world. And my concern, though, is that that's going to take a lot of work. And if the tariff risk somehow goes away, then the worry is that Canadians will feel, oh, we dodged that bullet. Let's not make all those hard decisions to improve relations across provinces. Let's not make all those hard decisions to build refineries in Canada or think about a pipeline infrastructure that goes to other markets beyond the US. So that's just my worry, that even if this tariff issue goes away, it doesn't, in my mind, automatically mean that Canada will take its medicine to do what's right to sort of build its longer term resilience.
So there's a real positive story actually to some of these tariffs, in that it's really putting pressure. It's going to put pressure on Canada and Canadians to really sort of step up our game even more, which is a good thing for us long term. I also think there's different ways currencies could move based on how this tariff story works out, but they're all opportunities for us to make money. I mean, if the Canadian dollar falls, if we have more money invested outside of Canada, that means those investments are going to appreciate more, and vice versa. We could have more money in Canada and benefit from strength in Canada. So this is why we have both of you working on all of this on a daily basis. So thank you very much for that. Maybe I'll close off with one more question, which I think is I know it's something that we as a team has really changed how we do business and increased our productivity in terms of thinking of AI and thinking of some of these major technology companies that have been changing our lives. We like to call the Mag 7. And so, for those of us who have lived through the internet bubble in the 1990s, we've kind of heard of this story of new technology changing the world before, and inevitably it did. It worked out really well. I mean, we all sort of could not imagine our lives without these computers in our pockets that are all connected to the internet and how that's changed our lives. But it did kind of go badly before it went well. So do you think that, and maybe I'll start here with your Lauren, if you have an opinion on this, and then and go back to David. Do you think that history will repeat itself in terms of some maybe we'll see this story kind of go down from a Mag 7 standpoint before it'll go up, or do you think this is a lasting trend, and do you think AI will have significant impacts on the economy and where?
So I too lived through the late 90s. In fact, I worked for one of those internet companies for a brief period of time, so I know exactly what you're referencing. To get right to the point, absolutely, I think this is here. I think it's for real. I agree with your describing how it's changed your day-to-day work. We've certainly integrated it into what we do day to day. I think the adoption speed, if you think about the internet, or you want to use the iPhone, or cell phones to smartphones, call it a 10-year period where you really saw adoption ramp up. I would argue that we're probably in a much faster adoption period for AI. I think it's still to be determined exactly how it's going to be utilized. I think that many companies, I mean, if you look at just look at, and David may be able to speak to this in more specifics, but if you look at the amount of capital that's being invested by major companies throughout the US, throughout the world, be it into the chips, into the software that supports AI, into the staffing that can help understand how these things can actually help a business become more efficient, more productive. Listen, everyone's all in, and that draws that naturally brings up the question: is this for real, or is it an overreaction? My personal opinion is it's game on. This thing is for real. I'm not going to speak to valuations or specific companies that make more sense versus others, or software providers. But I certainly think that this will change the way we do business, the way manufacturers operate, and the list goes on. But I invite David to share some thoughts, please.
Yeah, what are Fidelity's thoughts on AI?
I mean, I agree. It's transformational. Technology and technological progress, especially as it relates to the market always overestimates the near-term impact and will underestimate the long-term impact. So we've obviously seen stock prices on the AI-related companies move dramatically higher. So that's the market trying to basically pull the entire future value of these companies into a price today. And we can argue whether that's fairly valued, overvalued, or potentially even undervalued in some cases. But the underlying fundamental technology, I think, is really, really amazing. And it can make, I think, many parts of the world much more efficient and really lead to an improvement in everyone's standard of living. So when I think a little bit about how to approach this from an investment perspective, I think information, at some point, it's a commodity. It's no different really than barrels of oil in the ground or gold in the ground. So as the technology improves, I think that price of information becomes cheaper and cheaper. So if you've been following the headlines with the launch of DeepSeek, that was able to do a lot of these AI tech calculations at a much more inexpensive rate than what was existing previously, that was a big step forward. We'll have to validate all of the models and everything that goes into that, but I think you'll start to see some of that certainly continue as just the processing part of AI continues to get more and more efficient. I think what we're waiting for, and I think the jury is still out, is what is the ultimate use case? So yeah, we can use ChatGPT to write funny poems and do little things like that, but at the end of the day, how can it truly improve your efficiency in your workplace? And just an example of, I think, how we're using it at Fidelity. So Sean, off the top, you mentioned the 1,000+ analysts that we have around the world. So these analysts are meeting with companies all the time. literally companies in every country pulling in information. And that information is exceptionally valuable, especially to somebody like me that sits as an asset allocator, making these broad investment decisions. But the challenge is that there is just physically not enough hours in the day to read all of the notes that are provided to me. So this is where something like a large language model helped with AI can really make a difference. Because what makes AI special in some degree is having a captive data set. So we've got this data set information that's proprietary to us. Nobody else has access to it. And we can just let the models run wild on that. So I can ask, based on all of our research, how are consumer companies feeling right now? How is, companies in Malaysia, to pick a country, how are they feeling right now? So all of that's exceptionally powerful. And it's something that I probably could not do without that technology, because it's just a question of synthesizing all of this information. So yeah, just as a quick example, that is, I think, just something that speaks to how transformational, how important this trend is.
Yeah, you might have to spend a few days reading all these research reports from all these consumer companies rather than at a click of a button, it can summarize for you where it's at. So certainly this is something, it's not as much in the news right now because tariffs are taking all the news, but certainly it's something that underlying can really drive productivity in the economy. And productivity is, a longer driver or at least I believe, to long-term returns. Now, I think with everything going on today, that we could be talking about this for hours, but in order to respect everyone's time and to respect the time that we set out for this evening, we're already over that. I'm going to end it here. I'll thank both David and Lauren for spending the time with us this evening. We really appreciate some of your insight. And the conversation doesn't need to end here. Like I said, continue to put any questions you have in the Q&A. We'll make sure that your dedicated financial advisor gets the answer back to you. And make sure that you have all the information that you need to feel comfortable about the future direction of your wealth, because that's what we're here to do. And to be honest, it's not just about your wealth. It's also, we care about all of you as individuals. It's also about your health. So if there's one thing that you took away from all of the different, possibilities that could happen in the future that we talked about today, but if there's just one thing you took away from this conversation, it's as I like to say it, don't get caught up in the play-by-play of what's happening and get jerked around or moved around in terms of what's happening from day to day. The professionals don't do that. And there was another colleague of mine in the industry here who brought up a great quote from Marcus Aurelius that I just wanted to share with everyone, which I think is great not only for our portfolios and investing properly, but also great for our health. Marcus Aurelius said that we don't always have to have an opinion on everything. There's no need to actually get worked up about everything that happens in the world, and especially things that we can't control. We can actually choose to reserve judgment for a while and let things play themselves out. Because often with judgment comes emotion, and we get the emotional response to that, and that causes stress, and that stress causes, not only implications to our portfolio if we're getting jerked around, but also to our health. And I hope you all feel after today too that you can feel comfortable knowing that there are unemotional professionals that are doing very, very deep research. We're talking about thousands and thousands of people amongst our partners that are on the ground meeting with all of these individuals and kind of getting the real information. And that's what we do on your behalf to make sure that you're getting the long-term disciplined results for your wealth and your investments, to make sure that you have the money that you need today so that we advance your lifestyle through all stages of your life and even through generations, so that you can even impact the people that you care about and the causes that you care about over time. So if you'd like to have a deeper discussion, please reach out to your dedicated financial advisor. They'd be happy to discuss this with you further. But finally, on behalf of everyone at Endurance Wealth Partners, at CI Global Asset Management, and Fidelity Investments, we'd like to thank you all for being with us tonight. Wish you a great evening and have a great March break next week. Thank you very much.